Okay, good morning, ladies and gentlemen. Thank you all for coming out to the Subscribers Investment Summit this morning. We all really appreciate your support, especially at a time like this when we've just come through such a terrible market. And it's not all darkness. I think there's some reason to be optimistic here, which I'll get into as I get going on my talk. A lot of people, of course, have given up on the resource industry entirely after the terrible year that we had last year. And it's really encouraging to see that there's still some people that recognize that coming into the markets at the bottom of the market cycle is the best way to make money in any kind of investing opportunity. The challenge is to know when it's the bottom. And at this time, as we're looking out into the future, the questions are, how long will it be before the recovery in these markets gets underway? And will there be even better opportunities in the meantime? To understand what's coming next, first let's look at how we got into this situation. Everybody here, of course, knows about the situation in Europe, and we've heard about the $16 trillion of US debt and all the other unfunded liabilities. And we've all heard about the so-called slowdown in China. All this creating a great amount of uncertainty in the financial markets globally and people fleeing from risk. Further downward pressure came over the last year as the metal prices came off from their highs. But there's another factor that I want to touch on here that's really, really important in understanding what's going on at this moment in the markets. I've talked about this a little bit in the newsletter, but I really want to emphasize this point because it is really, really important. This chart shows the amount of new financings that were done for TSX venture-listed companies going back about a decade. And you can see that in that period, 2010, 11, and 12, and sorry, the slide should be updated. 2012 came in, the final number was $6 billion. So there was $26 billion of new money came into TSX venture-listed companies over that 3-year time period, more than at any other time in history. Billions and billions and billions of new shares were created from that money. But unfortunately, a great deal of that money was spent without generating a lot of value. And the net result is that, in my opinion, most of the junior resource companies are still overvalued. If you think about a company that has no real assets, and there's lots of companies out there that have been looking to make a discovery for years. And maybe they're right on the brink of a new discovery, but if they don't have it in hand, they don't have a real asset. And if they have mediocre management, no cash, and no prospect of raising cash, what is their fundamental value? Not very much. And a lot of those companies are still trending toward that fundamental value. So there's companies that are trading at 1 or 2 pennies that are still overvalued. And all those companies that are still trending down are creating a negative feeling toward the junior resource markets that's kind of painting the entire industry with this negative brush and giving this feeling that this is not a good industry or a good place to be investing or a good time to be investing. But that's not necessarily the case. Not all of these companies are equal. There's never been a time in the 30+ years that I've been involved in this industry, I've never seen a time where it's been more important to be selective in the companies. Oftentimes we'll get the market running up and everything does well, and then it comes back down. But at this point, we're in a real divergence. We're seeing a lot of companies that are real zombies that are going to continue to just sort of flounder, while there's really, really good companies out there that are trading, in some cases, for not much more than cash value, that have good assets and good people and cash and access to cash. Now, we started to see a rally in some of the better quality companies at the start of the year. And here's one that we introduced in the newsletter last August. And it did very well for a while. But even a company like this, Santa Cruz, is coming off over the past few weeks as this negative mood is coming back over the market. The drop in the gold price over the last few months has rattled a lot of investors. Gold is down because people once again have confidence in paper currencies, at least in this moment. Anybody who takes even a short look into the future will recognize that $16 trillion of debt in the United States and the euro problems and all of the other situations affecting currency is not going to go away soon. In fact, now we're in a currency war. Japan has joined in a big way, and they're all racing to the bottom. And it looks like the dollar is strong because it's not falling relative to the euro or the yen or the pound. But they're all dropping in tandem, and therefore we're not seeing what's really happening. Quantitative easing that we hear so much about is really just another way of printing massive amounts of money with no real backing. And that's going on and on all over the world at this time. So while gold prices come off a little bit from its high, if we take a longer term perspective on it, and this is one of the big problems with investing everywhere in this era, especially in the internet era, where we're also used to instantaneous information, we tend to think of trends as being, within our 3-day settlement period. Or, a long-term trend is a week or two. But if we step back a moment, look at the gold price over 10 years. It's up 6-fold in that period. Every single year for 12 years, the gold price has risen. And if we look at it from that perspective, we don't need to get excited about a little drop. That little blip on the right side of the chart is what people are focused on in this moment. And if you take the longer term perspective, you realize that every time in the past 12 years, when the gold price has dipped, investors that have come in and taken advantage of that dip have done very well. And I don't see this time as being any different than any of those other periods. The fundamentals have not changed. The currency problems have not gone away. And I'm not a gold bug. I'm not saying, gold is going to the moon. But I'm saying if we look at that trend for 12 years moving higher and just keep pushing that further out into the future, that's how I see the gold price. In fact, the gold bugs that are trying to convince people that it's going to $2,000, $3,000, $5,000, I've heard $30,000 as a forecast for the gold price. Those people have done so much to destroy the credibility of this entire industry. It's really frustrating. So just step back from this financial collapse and gold going to the moon kind of mentality. Look at the gold price as a commodity that's trending higher and recognize that there's a lot of reasons to own companies that are involved in this sector. Okay, so that's how we got here. Now let's start looking forward. Let's start with the global picture. There's fears of the complete collapse of the euro have abated. There's still some people that see that coming, but it's not as intense as it was months or a year or two ago. The economy is still in recession. So that means that Europe is using about the same amount of metal, maybe 1% less metal than they used last year. They haven't stopped using metal. The US is growing slowly, a couple of percent a year. That means they're using a couple of percent more metal than they were last year. China, growing at 7.5%. We're used to it growing at 10%, so when it only grows at 7.5%, we talk about a slowdown in China. China's using 7.5% more metal this year than they used last year. Add it all up around the world, demand for metals is increasing at a furious pace. China is by far the biggest user of metals, and it's growing at 7.5%. So demand for metals is continuing to grow. Existing mines are being depleted at a pace that means every decade the mining industry has to replace half of its productive capacity just to stay even. It's getting harder and harder to find new metal deposits. Looking longer term, the fundamentals for the mining industry have never looked stronger. But in spite of that favorable long-term outlook, at this moment, investor sentiment toward the resource market can best be described as fear and loathing. Fear of anything risky in general, and loathing or disgust at the mining industry because of the terrible performance of the mining industry over the past couple of years. There's the gold miners' ETF, sort of an index of the larger gold mining companies. Dropped off last year, and then toward the end of the year, there was a bit of a recovery. And then it fell like a rock over the first couple of months of this year. And what's happening? The large mining companies are taking enormous write-offs. Kinross has now written off most of the $7 billion acquisition cost for Redback. Barrick took a multi-billion-dollar write-off last year. Most of that was on their Equinox copper acquisition. Overall, the mining industry wrote off $50 billion last year. Not the sort of performance that gives investors any kind of comfort or confidence that these guys know what they're doing. And on top of the write-offs, the largest mining companies have announced deferrals on billions and billions of dollars of capital expenditure programs. Huge deferrals or delays or complete cancellations of new mining projects. Those huge write-offs have further dampened investor sentiment for the junior resource industry. There's a sense out there that if Barrick isn't going to build any new mines, what value is there in a junior that was hoping to sell its deposit to Barrick? Well, here's where it gets really interesting, because Barrick and Kinross and the other Western-based mining companies are not the only game in town. Let's just mention a couple of quick points about these deferrals of the capital expenditure programs. Some important points flow out of that. First of all, Barrick's takeover of Equinox Copper was an indication of how hard it is to find a big gold deposit. Barrick tried to convince its shareholders that it was better off to develop a copper or buy and expand a copper deposit than it was to continue looking for gold. They said that not because they really believed it, but because they couldn't find a suitable big gold deposit to focus on. And that means that the juniors that have gold deposits have very, very valuable assets, even if they're not getting recognition from investors at this moment. The last time that the gold mining industry found as many ounces as it mined was in 1998. We've been steadily depleting resources and reserves of gold deposits since 1998. And the slowdown in the spending across the mining industry is very supportive of higher metal prices in the future. We're already facing tight supply situations for most of the metals. Demand is growing, it's getting harder to find and develop new deposits, and now we've heard these announcements about huge deferrals in capital spending, which is going to further tighten the supply constraints and put more upward pressure on metal prices when you look a couple of years out into the future. But the really important point here is that the established analysts and investors in the mining industry are looking at the big Western-based companies as being the only game in town, and that just isn't the case. Last year, toward the end of the year, 2 of the companies that we follow in Resource Opportunities were taken over, both for cash deals, both priced at about double what the shares were trading at before the takeover offers. The total value was $600 million paid in cash. One of those offers came from a private Brazilian mining company, and the other offer came from a Chinese mining company. There are literally hundreds of mining companies around the world right now that are capable of writing checks for hundreds of millions of dollars, and they will be writing checks for hundreds of millions of dollars. They will be acquiring the junior companies that we see around us today. And I would hazard a guess that a typical analyst here in Toronto, the mining finance capital of the world, couldn't name a handful of those hundreds of companies that could write a check for hundreds of millions and are presently looking for acquisitions. And it's not just emerging market mining companies that are in the game now. There's a large number of other investors coming into this arena that are completely off the radar of most of the people that are looking at this industry. I won't get into the detail here. This slide is in the presentation package. But there's state-owned enterprises, like especially the Chinese ones, where finding secure sources of supply is more important than making money. There's sovereign wealth funds. There's private equity. The metal trading companies are getting concerned about locking up supply sources. And there's corporations that rely, especially on strategic metals, that are making equity investments to make sure that they've got supply in the future. So there's lots of money coming into this sector. We don't need Barrick or Kinross or Rio Tinto to make acquisitions. There's lots of money out there coming from other sources. Just a couple of quick points here, and I don't want to really belabor this, but I just touch very briefly. This shows the nickel price, and where that arrow comes in is where Canadian investors are sold Inco and Falconbridge to Vale and Xstrata, respectively. Now you can see what happened to the nickel price after the acquisitions. And the gain in the nickel price and the profitability of those companies was such that the payback for those investments took place in less than 2 years. There was a whole series of other similar takeovers at absurdly low prices, at least absurdly low prices relative to what took place after the fact. And just one other quick point in this regard. Bloomberg did a study going back about 6 years on forecasts by mining analysts of the gold price. So each one of those downward trending colored bars represents a 3-year gold price forecast for each of the years from 2006 forward. And you can see that in almost every case, the analyst consensus, this is not just one or two analysts, but this is all the analysts that Bloomberg could find, and they added them up and took the average. The average forecast for the gold price for every one of those periods, with 1 year exception, was to take the current price and go downward. How much thinking went into that? And to show how bad it is, by the 3rd year of the forecast, the average was less than half of what the actual gold price was for that year. And that's what's happening in the market right now. So we've got these analysts out there creating this horrendously negative mood because of China slowing down and recession and all of these factors. And yet you can see how accurate they've been in the past. And my point being, we're at a low point in the market. In general, it's a good time to come into the market. But I would just qualify that normal, come in at the bottom of the market with a caution that possibly the majority, in fact, I'll be perfectly blunt here, the majority of the junior resource companies out there are still overvalued and will go lower, and it's going to create the feeling of a market going down. But within that, there are gems. I don't know what the number is, but it's 10, 20% maybe of the 2,000 companies out there represent real outstanding value. And because the entire market has been sold off so brutally, there's outstanding value in those companies. And that's what we're focusing on. And the companies that are here today are companies that we believe are in that sector, because we've invited these companies here, and the companies that the three of us follow in our newsletters, we focus on those quality companies and try to differentiate between the market, which is still overvalued, and the high quality companies that are coming back. So why is it going to come back now? Well, we're getting over the doom and gloom economic outlook. The US eventually is going to sort out the political mess. And when they sort it out, there's $2.5 trillion of cash sitting in the bank accounts of American corporations waiting to go to work. But they're just waiting for clarification on taxes and all the rest of it. And that's going to really kickstart the American economy. Europe is coming back. Japan is doing a lot to kickstart everything. China, hey, 7.5% is not a bad rate of growth. So, and in spite of it, and just looking at the gold companies, which is really probably the best place to focus right now, because the gold price is down, and as I pointed out, every time it dips, it's a good time to come in. Carefully selected gold companies give you exposure to the longer-term gold market, and if they carry out their business plans, they can add enormous value in the near term. And that's really where I would encourage you to focus right now. I want to talk, I won't even talk about this because I'm out of time here, but the flavor of the month, and my subscribers all know about, my kind of sarcastic comments about the flavor of the month, these various fads that come and go. But right now, the popular trend in resource investings are royalty and streaming companies, because it's a lower risk way to play the resource industry. Now, we've had tremendous success with Silver Wheaton, and we've had tremendous success with Sandstorm Gold. I'm looking at a number of other companies that are in that space. There's a number of new ones coming out. And that's a very, very important area to be looking at right now, because it's a lower risk way to play the industry. So, good time to come into the market, but be very, very selective, and don't need to rush in. And we'll just see where the market goes over the next days and weeks here. So with that, I'll turn it over to the mining companies and hear from them about the drivers and the milestones and the good things that are going to create value for those companies.